Basically what you're doing is you're saying, I'm going to go ahead, put my life's future in the hands of someone who's a really nice guy, but he also doesn't put my interest first.
Right. Welcome to the Retirement Today podcast. My name is Zach Holcomb, and alongside me, we have Michael Reese. He's a certified financial planner and president and founder of Centennial Advisors. If you're listening to us on our show, happy to have you along with us. But if you're watching this on our YouTube channel, remember, if you want closed captions, you can click the button indicated below. And as always, we'd love to have you subscribe to get notified about all of our latest content and videos. You can click the big red subscribe button below that's also indicated here. Mike, I'm super happy about today's show. We have a really exciting topic, but I'm also pumped about our brand new setup again, right?
Yeah, I love this. As you can imagine, we are doing our best to continue to improve our visual set.
Yes.
You know, we want to be at least semi-professional here, right? But anyway, and one I noticed, so you forgot, we've got the subscribe button below, but don't forget, Zach, if people like this, they should hit the like button, and they should share this with their friends if it's a topic that they think it would be helpful with their friends, right?
Yeah, absolutely.
Okay, fantastic. So this week, I got a great topic. By the way, you're going to love this, you guys. We're going to talk about a question we get all the time.
Sure.
So, in fact, last night, we were doing one of those dinner events where, people come in, we give them dinner.
A real live event?
Yes, we actually had real people.
Yes.
It was crazy.
Yeah.
Anyway, as I go around the tables asking questions, at two different tables, I got the same question. And the question was, are you a fiduciary?
Yep, I remember those.
And I thought to myself, you know what? That'd probably be a good topic for the show. And I also thought, I really believe that a lot of people, they hear that word fiduciary. I'm not sure they really understand what it means. So why don't we start there? What does it mean to be a true fiduciary? Zach, I'm curious. You were making fun of me last night for being old. Here's my question for you. So now it's my turn to see if I can flip this table a little bit.
Putting me on the spot? All right.
Yeah, I'm putting you on the spot. From your perspective, how would you define a fiduciary?
Well, from my perspective, and I have a lot of conversations, with prospective clients and people that are interested in our services, and this is a question I receive quite often. And from my perspective, a fiduciary is somebody that's working in your best interest and not in the best interest of the advisor. Client always comes first.
Okay, client comes first. I like that. By the way, I think the technical definition is something like a fiduciary is someone who has the legal, moral, and ethical responsibility to give you advice that is in your best interest and to disclose any potential conflicts of interest. So that's the technical definition, I believe, or close to that.
Right.
The way you said it, I think, is much cleaner. Right. It's like, hey, a fiduciary is someone that focuses on what's best for you without worrying about what's best for themselves.
Right. And I think the issue is, when we say this, it sounds like every advisor should be doing that. But unfortunately, that's not the case.
Yeah. So here's the deal. Every financial advisor out there, they want you to believe, right, that they're a fiduciary.
Right.
So here's another question for you. What percentage of financial advisors are truly fiduciaries?
I'm going to say it's less than 10%.
You must have been listening to me talk. It is less than 10%.
Yes.
Less than 10%. And by the way, so how do you tell?
Right.
How do you tell if someone's truly a fiduciary? Well, here's number one way to know that they're not a fiduciary.
Okay.
Number one way to know they're not a fiduciary is they work for a really big firm and you know who they are. They're a national firm, got a big name, and the companies, right? I probably shouldn't say their names.
Big buildings, name on the door.
Yeah.
Yeah.
They're on every street corner,
Sure.
Yeah. If your advisor works with a large firm, I don't care how much they say that they're a fiduciary, they're not.
Sure.
Because the problem here is that their primary obligation is for the firm that they work with. So if they work for ABC Brokerage House, right?
Right.
If that's who they work for, then they're not a fiduciary. It's kind of like, here, I can say this, I think. As an example, so we have we custodian our assets at Fidelity and TD Ameritrade. And if you talk to those institutions, maybe Vanguard's another one, where you talk to those institutions and you work with an advisor at one of those institutions, they want to say they're fiduciaries. But here's the problem: who writes their check?
ABC brokerage.
Yeah, whoever the company they work for, right?
Sure.
And if that's who writes their check, and the company that writes their check says, hey, I want to make sure when you set up your clients that you use this preferred group of funds to put in your client accounts, right away, that's what they're going to do. Is that what's best for you? No, that's what's best for the company.
Right.
They're not going to be fiduciaries. If you want a fiduciary, you only find them at the independent firms.
Sure.
That's the only place you find them. So this is kind of one of my pet peeves. So you ready for this?
You gonna get fired up? Yeah.
Oh man, one of my pet peeves is this. It's like people go around saying, I'm a fiduciary.
Right.
And then you find out that the only thing they do are insurance or investments.
Right.
So I'll give you a good example here. There's a big company. There's out of California.
Okay.
Fisher Investments, right? Big company. Ken Fisher writes for, I think, Forbes, right? They do investment management. That is what they do.
That's their wheelhouse. That's all they focus on.
Yes, they call themselves fiduciaries. Now, technically, for what they do, they kind of fit in the definition of fiduciary.
Right. But we're not talking about kind of. We want to be full on fiduciary, full picture.
Yeah, so here's an example. All they do is investing.
Right.
What if you need insurance?
Can't get it at Fisher.
Yeah, not only can you not get insurance at Fisher, they actually, because it's against their best interests to help you get insurance, because if you want to put money in, say, an annuity at an insurance company or into life insurance,
right,
that means you're taking money away from them. Is that in their best interest?
Not as the company, no.
No, and in fact, they're very active at telling you why you shouldn't do that.
Right.
They don't even care if it's in your best interest or not. It's against their best interest. So is that really being a fiduciary?
It doesn't sound like a fiduciary to me.
I don't think so. I think that if you want to talk to a true fiduciary, here's what I think. Here are the characteristics that a true fiduciary, what they have, what encompasses a true fiduciary. Number one, they can help you with all kinds of investments, whether it's investing in the markets, whether it's investing with insurance companies. They don't care. They can do everything.
Right.
That's really important, because if they can do everything, they aren't going to care. How they're compensated doesn't matter anymore.
Right.
Right. They don't care, because they're saying, look, our job is help you, and we don't care what tool we're using. We're just going to help you.
Right.
So that's number one. Number two, I believe a true fiduciary should be compensated or have the ability to be compensated in different ways. How about that?
Sounds pretty good.
Well, a lot of people, if you read about fiduciaries, how they're compensated, a lot of the articles say they're all fee-based.
Right.
Well, wait a minute. Insurance companies mostly pay commissions.
Yes.
If having some money with an insurance company is the right idea or the best idea for you, well, don't you want your advisor to tell you that?
Yeah, 100%.
And don't you want them to be in a position where they don't care if you do managed accounts or insurance accounts? I mean, they're compensated either way.
Right. So in the end, what you're saying is it doesn't matter how the advisor's compensated in this case, as long as it's in the client's best interest.
Exactly.
Yeah.
There are situations where commissions are actually better for the client. Other situations where fees are better. Here's another one. True fiduciaries should also provide, like if you want to work with them, but you want to manage your own money, you want to do all that yourself, they should also provide some kind of an engagement fee, how attorneys have these retainer fees.
Right.
A true fiduciary should have that as an option.
Right.
So the bottom line is you should be able to engage with them in a lot of different ways. And the reason for that is because a true fiduciary, their focus is not on how they're getting paid, it's on the client.
Right.
And they're just trying to figure out how do I put together different ways that my client can engage with me so that it's best for them?
Sure.
Not best for us, best for them.
Right.
So, of course, Zach, the reason we have this topic is because, as you know, I was talking to these folks, and they were working with an advisor, one of these big firms.
Sure.
And they loved
this
person.
Been working with them for years too.
They really thought he was a great guy.
Right.
And nevertheless, for whatever reason, they wanted me to do a double check on their portfolio. I'm like, why? You love your person. What do you want me to double check what you're doing for?
Right.
Why are we doing this?
Right.
Well, we just want to make sure we're not missing anything. And I made the mistake. What I normally say in that scenario is I was like, well, let's say you are. I mean, you love this guy. You going to leave him? I mean, if he's not giving you what you want, you leaving?
Right.
And you going to come over to us? Because if I asked that question, they would have said no. It didn't matter. It didn't matter what I said. They weren't going to come over. So it's like, why am I wasting my time?
Right. What are we even doing here?
But because I'm sometimes not, I don't know why, but I just did it.
You were in a good mood that day.
Maybe that's what it was. Anyway, so I run this report, and here's what I learned. You know what revenue sharing is?
I believe so.
So what is your understanding of revenue sharing?
So in this case, the investments that the client was being put into, they were giving kickbacks to the company themselves?
Yeah, so here's an example. If you work with any big firm,
sure,
just type in the name of the big firm and then type in revenue sharing agreement.
Okay.
So if you were at Edward Jones, you'd say Edward Jones on Google, Edward Jones revenue sharing agreement.
Right.
Ameriprise revenue sharing agreement. Morgan Stanley revenue sharing, whatever the company is.
Sure.
By the way, if you find a revenue sharing agreement on Google, you already know you're not working with a fiduciary.
Okay.
Right away, you're not working with a fiduciary, because revenue sharing is where the company, here's what happens. So the big company, they have all these fund families pay them money or kickbacks in order to be on their platform.
Sure.
So if I were a big company, I would go to, say, American Funds.
Sure.
I would go to Lord Abbott. I would go to Franklin Templeton. And I would say, hey guys, if you want our advisors to put your funds in their clients' portfolios, you got to pay us money.
Right.
Kickback. And so these companies say, sure, we'll do that. And that gives them access to thousands and thousands of advisors, which is hundreds of thousands, if not millions, of clients.
Sure.
So this, by the way, is the absolute opposite of being a fiduciary, because essentially what's happening, if you work for one of those big firms, your firm is telling you, here are the funds. Here's what they say, right? They're so sneaky about it. They say, we've done the research. So Zach, if you were a client, I would say, Zach, we've done the research. And we have found that there's a certain group of fund families, they've got long time management, they've got better returns, they've beaten their benchmarks more often than not.
Sure.
So we've put together these managers, and it's like a preferred list of managers. As though the big company actually did some work here to make sure that these managers or these fund families were truly like the best out there.
I like when you say preferred list, because it's really preferred for the company, not for the client.
That's exactly it. So the reality is, at no point are they considering what's best for the client here.
Right.
They're only thinking about, how do we get as much money as possible from our clients?
Sure.
That's all they care about. So they put together this list. They go to the advisors and they say, all right, advisors, we've done the research. And the advisor, not knowing any different, says, okay, I'll put you in those funds.
Sure.
Our company's done the research. Here's why you should use these funds. I have spoken to a lot of investment advisors who are true fiduciaries. It's amazing, Zach, how when they actually run filters to find what fund is best for a client, like if you want large company stock, what's best for that? What position? What tool should you use? And it might be the S&P 500 index, which is free.
Right.
That'd be free to you. You could own the large companies for free. Does that sound good?
Sounds like a great deal.
Okay, so at a big firm though, well, those kinds of funds don't pay kickbacks.
Right.
So what's the fund company do, or the big firm do? They say, oh, no, we're going to recommend that you put your money in, say, let's pick on American funds for a moment, because American funds, there's a lot of money in American funds out there. Zach, I've run a lot of filters. Do you know how many times American funds comes up as the best fund to hold for the client?
I would say more often than not.
Never, ever,
really.
ever. Never, ever. Never does American funds, never is that the best fund to hold, ever.
Yeah.
So why in the world would a big firm say to you, Zach, I'm going to fill your portfolio with American funds?
Kickbacks.
Kickbacks. Is that what's best for you?
No.
No. So is your advisor really working in your best interests?
Absolutely not.
So is your advisor a fiduciary?
No.
So if you like the guy, basically what you're doing is you're saying, I'm going to go ahead, put my life's future in the hands of someone who's a really nice guy, but he also doesn't put my interest first.
Right.
Does that sound like a really good idea?
That's not a relationship I want to be in.
I mean, and so that kind of thing just drives me crazy.
Right.
Right? I find it so offensive. And so in this particular, and then by the way, same couple, they were in a platform where the advisor was charging them an annual fee.
Right.
And within the portfolio, and like call it 1% a year. And so I said, these people have like $3 million. Like, so how much are you paying this guy? What's 1% a year? $3 million. $30,000. Well, what does he do for $30,000 each year? Oh, he's great. He calls us about, a few times a year. We visit with him a couple times a year. Mm-hmm. He's great. Does he help you with your taxes? No, they don't do that there.
Right.
Well, what about your insurance? Like do you need long-term care life insurance? Does he help you with that? No, they don't really do that. What about your wills and trusts at least? Oh yeah, he told me we should get that updated. Well, did he have someone he could do it with you? I mean, did he send you to an attorney to get it done? Did he follow up? No, he just does investments. That's fine. If that's what they do, that's what they do.
Right.
Are those other areas important to you? Well, that's why we're here, Mike. Mike, well, but then when you dug deeper on the $30,000 he was charging them, inside the portfolio was a bunch of mutual funds. And when you look at the internal fees there, it was something like 0.92%. It's almost 1%.
Right.
There's another $30,000 going out to other so the advisor's getting 30, and the advisor put them in these different funds where the client's paying another 30. That's hidden, of course.
Right.
Every one of those funds were on the revenue sharing list with the firm. So what do we got? The client's getting double dipped. They weren't paying $30,000 a year. They were paying $60,000 a year.
It's a lot of money to pay to not work with a fiduciary.
And I asked him. I said, you've been with this guy how long? 20 years. Okay. So you've been paying him 2% the whole time, which is, you started with maybe $1 million, grew to $3 million. Let's say it's $2 million on average. On average, you're paying about $40,000 a year, which means, that's $800,000 he's made off you that you've been paying this firm.
Nice little chunk of change.
Imagine, what do you think your account balance would be now if you weren't paying that?
Significantly higher.
Because do you think they're the only people that know how to grow money?
No.
And then what's going to happen the next 10 years? You're paying them $60,000 a year right now. Actually, I'm sorry. I'm exaggerating. It was like $59,230.
Right, we got a little higher there.
You're paying, what if you're with them for another 10 years? That's another $600,000. And you're not getting any tax help. You're not getting any insurance help. You're not getting any estate planning help. Are you really okay with that?
I wouldn't be.
But he's a great guy, Zach.
Yeah.
It's like they wouldn't believe me. It's like they don't want to believe me. And this is the challenge. We get caught in this, but he's a good guy trap.
Sure.
Your finances, your retirement, your financial planning, you got to stop thinking about it like, oh, he's a good guy. This is your life. This is your financial security. You got to treat it like a business. It's like a business. And you got to make darn sure that you're getting value for what you're paying for.
Right.
Stop. It's kind of like real estate people talk to people like all the time. Stop looking at a house that real estate person would say, especially if you're a real estate investor. Stop looking at a house emotionally. It is a business transaction.
Sure.
The same is true with your retirement planning. You got to understand the relationship with your advisor every single time means more to you than it does to them. I have people all the time, they're like, man, I don't know how I'm going to tell this guy I'm leaving. They leave, they come to us and they find out, yeah, it turned out it was no big deal. We thought that we were a really big deal to the advisor, that we were really close with them.
Sure.
Here's the problem. The advisor that we thought we had a great deal with, a great bond with, they got 200-300 other people just like us.
Right.
And to them, turns out losing just one of us isn't that big of a deal to them. People act like it, So anyway, it's like I get so irritated when I see people who are clearly being taken advantage of.
Right.
All under the guise of, but he's a nice guy.
Right.
Focus on working with a fiduciary. Focus on a fiduciary. So that's kind of my message this week, I think.
Well, I'm glad we had this discussion, and I'm really happy.
Going off on that, right?
Right. And I think for a lot of the people that they question this, I think it's a lack of education on a lot of just the general public's part. They just don't understand what's happening with these advisor relationships.
Right. And a lot of times I like to ask this question: do you have a complete retirement plan?
Right.
What do I mean by that? Most people have an incomplete retirement plan. They have an investment plan. You say it all the time. An investment plan is not a retirement plan.
Right.
If all you have is an investment plan, you have an incomplete retirement plan. What are you doing about your taxes? What are you doing about your income? What are you doing about your insurance or your estate planning? A complete retirement plan encompasses all of that. And so, one of the things we always talk about as you're listening, as you're watching, if you're sitting there, you say, man, I feel like I have an incomplete plan. We welcome you to come visit with us. We'd love to talk to you. Let's help you complete your retirement plan. Let's make sure you're touching all the bases.
If you want to talk to us about any of these things, if you have any questions about investments, taxes, estate planning, our number's on the screen. You can always go to talktomike.com. We're always happy to have a conversation with you. Mike, any final thoughts here on today's show?
Just simply this. Listen, folks, here's the deal. Retirement should be the best time of your life. If you work with a fiduciary, you make sure all your bases are covered, you get that complete plan, then you can truly enter into retirement with those 3 C's we talk about. You want to be confident you're making the right decisions, you want to be in control of your finances, and you want that comfort, that peace of mind, knowing that no matter what comes your way, at least financially, you're going to be in great shape. So let's make sure that you're making those great decisions. And with that, I think we're good here this week, Zach.
I think we are. Great discussion. We'll see you next week.
All right, bye now.